today's video is going to be about why most traders will always fail trading US30 or indices in general. So I hope you guys take something from this, and I hope you guys learn something from this. Alright, so the first pair is going to be US30. US30 isn't a pair that I've been trading a lot, to be 100% honest with you guys. I just prefer trading Nasdaq if I have to go and trade the indices route. So let's get into it and let's see how we could have capitalized. Obviously, I haven't been looking at US30 in quite some time, so it's also going to be quite interesting for me to obviously try and evaluate and obviously see how the market moved last week. Hi everyone, so this was supposed to be quite a good video. I actually put in a lot of effort on Sunday evening to actually make this video quite great, but yeah, long story short, I never hit record on the laptop, so I do have the one with my face in and all the edits inside of it, but on the laptop there's just nothing. So trying to fake a video in a way that it will make sense and line up with the wording just doesn't make sense. We actually have a nice trend line. Sorry guys, I'm not yet to analyze the market actually. We're obviously doing Monday Madness. We're gonna touch on two things. This should have a nice pullback. But the key once again is gonna be about why does most traders fail trading indices. So when I started trading, once again, a lot of people were trading currencies because there were only currencies. So 8 years back, we didn't have Nasdaq, we didn't have US30, so we didn't have all this opportunity. So we were still really old school, and that's why I prefer trading currencies still to this day. It's not because I don't understand indices, it's just if you've been doing something for 8 years, trying to switch over just because of the hype, is obviously not something ideal for a trader. So number one is it's really important to understand that indices is volatile. Okay, so I'm going to be using US30 for this example. So indices is really volatile, meaning that it's going to move. Okay, you can blow your account really quick if you don't have good risk management. So if you look on social media, you always see these guys trading US30, Nasdaq, whatever it might be, and that's the reason you want to obviously jump into these specific bets. Okay, so the key once again is understanding that those guys, you always see the same thing. They always have a 2,000 Rand account, 5,000 Rand account, 20,000 Rand account, 50,000 Rand account. So number one, they have money. Okay, they have money at their disposal to lose in a way. So number one, if you're not afraid to lose money, it already becomes way easier to trade, because then the emotions is out of it and it obviously becomes easier. But the key thing is, what you don't understand is every time you see a trader, well, one of these big traders, they have 2,000 Rand in their trading account, they most probably have like 20,000 in their wallet. Okay, so that's what people don't get. You don't see their wallet. So why do they have 2,000 Rand every single time in their account then? Another form of risk management. If you only have 2,000 Rand in your account, you can only trade for 2,000 Rand. So now the key thing to indices is knowing that, I mean, look over here. Normally, obviously, we have the support area over here. So that is obviously where the buying pressure is at. But also we can see that there is a support level over there. So there's also buying pressure there. Meaning that price can buy from either this level or that level. Okay. So where you're trying to figure it out and you just keep entering, and you obviously have your stop loss in, and then you just keep moving your stop loss and eventually blow your account. What this guy does is he takes the trade. Okay, I'll go to the low time frames just now. He takes the trade and he risks a full 2,000 Rand. So he goes in full margin risking 2,000 Rand. If the market goes his way, he makes 24,000 Rand, posted on Instagram, and it seems for you that this guy is flipping accounts, which he is doing, number one. But number two, he just has a good risk reward and he's limiting his risk to obviously make more money. Okay, so that is the one key. Number two, if the price then dipped lower, what would he do? the same thing. You'll lose 2,000 Rand, losing 10% of his assets, then add another 2,000 Rand to the trading account. But now he looks at a 1 to 15. So he loses 2,000 Rand, but he makes 30,000 Rand. And that's why you see these guys with these smaller accounts that obviously makes a substantial amount of money. So number 2, why do people have thousands of entries when trading indices? So obviously in South Africa they call it barcoding, but in the way it's just the same thing that I've been explaining for quite some time on my channel as well. It's called stacking. So you guys will see a lot of hedge funds and banks, banks obviously run on stacking in a certain area of supply demand. So what they will do is they won't try and figure out if the market is going to buy and get that sniper entry. So if you see these guys also with sniper entries, and the reason I'm talking about these guys in a way is these guys are flipping account from 2k to 20k, and they are 100% doing it. So they're obviously not showing you every time they lose the 2,000 or 4,000 Rand, but they're posting the time that they're making 20k, which doesn't matter, because in the end they're making money because they have a structure that they're following. That's what people don't get, and that's the biggest reason people lose money on, especially indices. You don't have a plan. You're just going into it, and every single time you're depositing $100, I hope you make it this time. If you don't, then next time you find again. Then what they do, obviously they have a little bit more entries. Obviously in South Africa, people love them, love the barcode strat. So every time the market dips, they buy again, they keep buying the whole time. And in this way, what they're doing is they're just increasing the risk reward. So rather than smothering their trade once again and having the smaller stop loss, then obviously they just keep entering and then increasing the risk reward even more. So if it does go all the way down, they have a 1 to 30 risk to reward, meaning that on that specific position they're risking maybe $10 off the $100, and they're making obviously $300 for that specific. So in the end you need to risk the 2,000 Rand in total on the specific month. Okay, so then let's get into the supply Sunday of things, and let me show you guys how we implement what I just showed you guys, but also adding to the fact that we obviously how we could have capitalized on that week. So the key thing once again is understanding that you always need to start on the higher time frames. A lot of traders think that you start on the lower time frames, and you see these guys floating on 15-30 minute, but in the end they first went to the bigger time frame and then the smaller time frames. So same thing like I showed you guys now. We have selling pressure there, we have selling pressure there, and we have selling pressure there. So you're sitting in your house now and you're trying to figure out where's the market going to sell from. They don't care. They're going to sell 2k there, 2k there, 2k there. If they win, if they lose and lose and lose, then obviously they're going to make 40k back. So once again, point of confidence. So if you add your fib from your high to your low, you'll see there's a 61 fib that lines up with the selling level as well. So that obviously creates an area of supply over there. So already we know we're in a selling trend on US30. We rejected on the daily. We had perfect hangman candle on the top of a trend for me, evening star formation as well. So we knew going into the week, doesn't matter what time frame, 30 minute, 1H, whatever, we are looking for sell positions. Price then comes, forms a high, a high, low, a high, low. So this high, low becomes the point to break for us to start selling. Then market forms a lower high, indicating a possible shift of momentum, indicating that we're not taking buys anymore. So if you are in a buy, you want to close your position out because we do have the lower high. Price then breaks to the downside. Once we have the breaker structure to the downside, then obviously you're waiting for the pullback into your zone to start selling. So this is now obviously how you implement it on the smaller time frames. Okay, so now you're going to start selling. A little bit of a bigger stop loss. Once again, don't try and smother your trade, and we're going to obviously try and get that trade, risk a full 2,000 Rand and keep entering as we go up. So in the sense, we're risking 2k, we're going to make roughly about 12,000 Rand, and boom, 12,000 Rand. I mean, we could have extended the TP and we could have made like 20k. Okay, so one good trade like this obviously, and you are done for the week. You're up 10 trades, meaning that you need to lose the next 10 trades for you to actually be in the negative. So what the key is, if you get a good trade like that, I mean, after that sell just went straight through, after you close below, you just do trade management. Okay, so managing your trade, obviously meaning that you don't need to exit unless the market gives you shift of momentum like I just explained. So now we do have this area of demand over here, and that is only when we exit, because we can now see that price is reacting to this specific level. But we are up 20,000. So let's say we had 20,000 in and we're up 20,000, we're up 40,000 Rand, or obviously $2,000. Okay. So now if we're doubling our account with one trade, that means that we can move our risk to 4,000 Rand now, or to $200. So from now on, if we take a trade like that, we're risking 4,000 Rand, $200, and we're making $2,000, or obviously making 40,000 Rand. And that is once again why a lot of traders fail, because they don't understand the concept behind that. And you can take that concept and you can apply it pretty much on every time frame. So the key thing once again is knowing that we're in a selling trend on the bigger time frames. And once you understand that we're in a selling trend on the bigger time frames, you can obviously wait for that shift of momentum. I mean, that's not going to go away. But once we have a break of structure there already, you can jump into that trade over there. Boom, perfect sell to the downside. And then obviously your risk reward will look something like this. So a little bit of smaller SL, but obviously a smaller TP as well. Then every time we form a low point, then we wait for the break of the low point, and then we obviously execute on that trade over there. Then when we have another break of structure over there, we know we're looking for a pullback, but we just sold from the 61, so we must be looking for the range of the 38% fib. So missing our entry, no problem. Then we have another low break of structure, and then we have another pullback, sell continuation. Then we have another break of structure, and now we're just running it to the downside. So we're not trying to figure out, because we know obviously that we are on a selling trend and we're looking for that sell continuations to the downside. And then you just keep repeating it. Then price obviously formed that higher high, taking out the market over there, and now we're starting to trend to the top side. So now we know, perfect, we have a higher high, we're forming a higher low. So if price can close above here at this moment, then we're obviously looking for a continuation trade on the specific market as well today, and then look to run into the top side. So just like that, it's a simple execution, because we're looking at the market structure. We already have the plan in place, so we know what risk we are implementing, we know what lot size we're implementing, and we know we only need to win 1 in 5 trades, 1 in 6 trades to actually be a profitable trader. Alright guys, thank you for everyone that is watching and supporting. I hope to see you guys on the next one.